Yoga is the journey of the self, through the self to the self. On this auspicious day of International Yoga Day, Namaste and good afternoon to all the dignitaries and participants. I, CA Ashita Shah, extend a very warm welcome to everyone in today's session under the aegis of Continuing Professional Education Committee of ICAI. Before we commence, I would like to apprise about CPE Committee. The role of a chartered accountant is evolving continuously to accept newer responsibilities in a dynamic global environment. The future of CA profession depends on being flexible and open to innovation. Therefore, the need of the hour is to innovate as per the requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. The committee also believes that members of ICAI should look beyond the traditional areas of practice, seek and explore new areas of business and profession. And hence, the CP committee is mentoring the members by providing guidance through various workshops, seminars, national conferences, background materials, etc., and simultaneously by encouraging young and dynamic professionals to grow as a speaker, master of ceremonies, etc., in CPE programs. So let me take the pleasure to welcome you all on today's webinar on practical experience in faceless assessment and GST issues in real estate sector. Keep your fears to yourself, but share your courage with others. Such is the thought process of our dynamic leader, our chairman, sir, CA Purushottam Khandelwal. He is chairman CPEC, vice chairman at CMP, and career counseling committee of ICAI. Also, he is deputy convener of UDIN Directorate. He is having 25 years post-qualification experience in the field of audit, direct and indirect tax, and intellectual property rights. This year, he is devoted to fortifying CPE framework and guaranteeing quality across its entire operational spectrum. And this year, major focus would be on upgrading of CPE portal and mobile app for enhancement of branding and professional competency of members. With this brief introduction, I request Chairman Sir to share his words of wisdom. Over to you, sir.
Seminar. So first technical session of the webinar, CA Prashant Maheshwari ji, a partner in EY, moderator Ashita Shah, Yash Shah, second faculty in absentia Amish Khandar, committee from the CPE, Payal and my team. It gave me immense pleasure to welcome on this webinar. Today is the Yoga Day. Happy Yoga Day, because Ashita is already started with the yoga. तो योग का मतलब होता है जोड़ना, और कमेटी ऑन कंटिन्यूड प्रोफेशनल एजुकेशन CPE कमेटी इज दिस ईयर डेडिकेटेड टू अपडेट विथ नॉलेज. नॉलेज के साथ मेंबर को जोड़ना, ये हमारा काम है. हम इस साल कंटिन्यू ट्राई कर रहे हैं कि आपको कैसे अपडेट रखा जाए, बिकॉज इन द चेंजिंग सिनेरियो द नॉलेज इज द ओनली फैक्टर which is compulsory to provide a professional service. What we are selling services. So if we are not updated, tomorrow will be the out of dated. So it's on a continuous basis. Learn, unlearn, and learner. This is the mantra of this committee. And this year, my committee is dedicated to come with a technology in the CPE committee. We are coming with a mobile app, which the attendance will be recorded by the mobile OTP. I'm not saying about the biometrics. It's not a biometrics, but physical signatures will be outdated soon. So you need not to sign a physical, and you will be get a real update real time. If you are attending programs, your CP will be automatically updated by the OTP. So end of the month, we will send you the mail that how much CP you have already completed, and this is the pending. So member will be easy to attend another programs. So CPE committee is a very, very important committee. Apart from the CPE committee, I am the vice chairman of committee for member in public service. I got an opportunity to meet all these members, those who are in the public service, those who are IAS, IFS, income tax commissioner, foreign services, ED, CBI, day before yesterday at Srinagar. They have a very good connection with the ICI and they are ready to help ICI because they are on the other side of the table and they want to work with soldier to soldier in ICI. So those who are in the public service, they are also helping us. Currently, ICI is working on the scale and speed both. Our visionary leader Aniket Pai Talati and the Ranjit Agarwal is doing a lot of work for the upliftment of the members and the student. So I will not take much of time. Today's first session is selected for the upgradation of knowledge and those who are in the income tax practitioner, the practical experience of the faceless assessment. So it's a very difficult now. There is no face. So those who are in the based in the writing, because we are not seeing the face, हम face नहीं देख सकते, लेकिन जिसके लिखने की एबिलिटी अच्छी है, एनालिटिकल स्किल अच्छी है, वो ही इस प्रैक्टिस को अच्छे से कर सकता है. So whether they are young or a senior, it doesn't matter. If you are very good in the writing skills, it will know your knowledge. They will save your client. So the Prashant Maheshwari is an expert in this field because they are heading the tax head and partner in EY. So they will apprise you how to be practical experience, what the practical experience done by the Prashant Bhai, they will share with you. So it will be added value to your practice. So I will not take much of it. Again, I welcome all of you and take a program forward. Ashita.
Thank you, sir. Gratitude is a quality similar to electricity. It produces discharges and must be used in order to exist all. Thank you very much for sharing your word of wisdom. After this amazing motivation from our chairman, sir, our participants are all the more keen to welcome a wonderful evening full of knowledge. This afternoon, we'll have 2 sessions of 1 hour each, and topics are practical experience in faceless assessments, and the second one is GST issues in real estate sector, including works contract, government contracts. Our eminent speaker will talk about above mentioned 2 emerging areas of professional interest. So moving on to the first segment of the evening, practical experience in faceless assessments. We have with us our point man for the day, CA Prashant Maheshwari, with us to share his knowledge and wisdom. Mr. Prashant holds degree of a Chartered Accountancy, Company Secretary and LLB. He has experience of around 17 years in corporate. He has good knowledge of international taxation and transfer pricing. With this brief introduction, I welcome Prashant, sir. Sir, the virtual dais is all yours. Over to you.
Thank you, Ashita, for such a warm introduction and a welcome. Thank you, our Honorable Chairman Purushottam Bhai, for giving me this opportunity to present in the first webinar for the CPE for this year and for this our August Institute of ICAI. Thank you to my colleagues, Yash Bhai, Krishna Bhai, and everyone. All my professional colleagues, thank you for giving me this opportunity to present my views on this very typical topic in today's time of faceless assessment. I was just thinking, since it's a topic of faceless, should I just mute my camera and start the discussion? Anyways, let me just start the discussion. And I would just start by thanking government for this such a important initiative. I know there may be some pockets where people may have some difficulties, but I would appreciate this is a very important and a very good initiative taken by the government for the faceless assessment. I personally, as a taxpayer, tax professional, is very happy because in the physical mode, when you are able to attend only 1 hearing in a day or 2 hearings in a day, in the faceless scenario, you can attend multiple hearings in a day with a lot of cost saving in terms of a lot of time saving in terms of the logistics, in terms of the waiting for the tax officers and all those things. So I think those things have improved significantly with the introduction of this faceless assessment scheme. Okay. Let me just share my presentation and we start with a quick introduction about it. Just a second. Ashika, just a quick check. I hope my screen is visible.
Yes, the screen is visible.
Yes, sir. Yes,
Great.
sir.
Okay. So I think in terms of experience, I have seen after introduction of this scheme, there is a lot of improvement in the way department is functioning. A lot of the way the assessments used to happen 4 to 5 years back before introduction of the faceless assessment scheme, and the way assessments are happening today is a significant change in the way the dynamics are changing. Let's see how it all started. We all know digitalization of the tax function is an agenda of the government, and we have all seen this entire things have started from few years from now with the introduction of GST, which was one of the most path-breaking tax reform for the government. And post the introduction of the GST, government has launched Project Insight. Project Insight is one of the flagship project of the government. The intent of the Project Insight was to increase or to widen the tax base of the country. If one just look at the statistics of the taxpayers in India, somewhere around 7-8 years back, even less than 2% of the Indian population was paying taxes. This tax base has increased almost to 6 to 7% in last 7 to 8 years. If one looks at the progress, I would say it's a commendable progress because of the Project Insight, wherein government has adopted lot of technology initiatives and incurred lot of cost for this. But yes, this cost was worth it, and it is actually yielding results for the government. This Project Insight progressed further with the introduction of the e-filing integrated system, wherein we all know as an individual taxpayers, now our income tax return is largely pre-filled by the government. And if you don't have any complicated transactions, filing of your tax return itself is a very simplistic task for you, because government is giving you a almost pre-filled income tax return, where if you are okay, you find the data is almost in line with what you have earned during the year, your filing of the tax return is very simple. Again, definitely, as compliance is easing out for the taxpayers, definitely government is also willing to put more and more controls in place. They want the taxpayers to be compliant, because of which they are strengthening their information exchange mechanism. Government has entered into various information exchange agreements with various governments in various governments of overseas countries. At the same time, not only out of India, government is also increasing the information exchange mechanism with various authorities in the government department itself. We know there is a lot of information exchange which happens between CBIC and CBDT and other authorities. So at this point of time, as a taxpayer, as a corporate, as a businessman, you have to be very consistent when you are presenting your data before the income tax authorities. You need to reconcile it with the GST authorities. Our income tax return also has a format in which you have to give the details of the income on GST paid on all such income. So this is something which is again getting a lot of integration of the data by the government. With the introduction of the e-invoicing for the GST, various transactions are tracked on real-time basis. Your invoices are getting verified on the government portal on an immediate basis. Thereafter, with the launch of faceless assessments and appeal scheme, the entire dynamics of the tax assessments have changed. This is the main topic. We'll be discussing it in a lot more greater detail in the subsequent slides. Thereafter, if you see, there is a TDS on even the sale of the goods. So if one looks at entire big picture, the entire thing will only talk about government is looking at reconciliation, integration of lot of data. This is something which clearly brings us to the point where they are compelling all the taxpayers to relook at the traditional ways of working. You cannot continue with the traditional ways in which Let's look at how the history of faceless assessment has evolved. The entire momentum started in the year 2015. This was a pilot project from the government wherein they introduced faceless assessment, not faceless assessment, they introduced email-based assessment for certain larger locations. Now, that was the first initiative wherein the technology or traditional ways of doing assessments through the physical submissions started taking some diversification. Some locations started with the email-based assessment wherein you are required to send many responses to the tax authorities on email. And email-based assessment is not something which was getting introduced in the income tax department only from 2015. We all have seen, even when APA proceedings used to happen in the earlier days, even APA authorities were doing a lot of communications with the taxpayer on emails. So probably this was something innovation started quite a back, but yes, it started coming for all the public at large from 2015. Thereafter, there was a launch of e-proceedings module in 2017. Thereafter, the launch of e-assessment scheme in 2019. This was one of the most important event, or probably I would say a timeline wherein the government introduced e-assessment scheme, and they, in part for the purpose of greater transparency, majority of the taxpayers were required to upload their submissions on the income tax portal. But even after the introduction of the e-assessment scheme, the filing of the submissions was on the portal, but practically all the assessments, all the interactions with the tax authorities were with jurisdictional assessing officer, and majority of the discussions were in physical mode. So practically it was only the way you are exchanging your communication, you are doing your discussions with the tax officer, sorry, not discussion, but way you are giving your submissions changed. But practically on the ground, you are again dealing in the physical mode, dealing personally with the tax officers. This entire scheme took a significant change with the introduction of the faceless assessment scheme. E-assessment was replaced with faceless assessment. The entire intent of the government was to eliminate interaction of the taxpayers with the tax officers. So this was the event where, if I just remember, 13th August 2020 was the date in which the faceless assessment scheme was introduced for the first time. With the introduction of this scheme, the entire dynamics changed significantly, wherein there was completely no interaction with the tax officers, and the scheme was launched on an immediate basis. Definitely, COVID-19 augmented the entire faceless assessment movement. When the scheme was launched, the scheme was launched with having a national faceless assessment authority at the center. This National Faceless Assessment Center was supported by regional faceless assessment centers with various assessment unit, verification unit, technical unit, and review unit. This was largely the structure, but if we observe as a taxpayer, there were quite a few complications, there were quite a few procedures which as a taxpayer was required to adopt. With this, some changes, some tweakings was done in the scheme, and this entire scheme was introduced as a part of the faceless assessment scheme. This got codified in the Income Tax Act by introduction of Section 144B by the TOLA Act of 2020. This entire act was made applicable from 1st April 2021. Technically or practically speaking, there was nothing a major change when the scheme was introduced in the act by introduction of Section 144B. Practically on the ground, the entire scheme was introduced in Section 144B. But as we all know, as even department is also innovative, and as a taxpayer, we are also very innovative when it comes to interpretation of the law. There were various provisions where a procedural observations, because of which a lot of litigation happened on various procedural part, because of which again there was a significant overhaul in the entire faceless assessment in 2022, wherein entire Section 144B was amended and new Section 144B was introduced. When I say the new Section 144B was introduced, there were quite a few significant changes which were introduced in the faceless assessment scheme. I will just take you through the current procedure. I am not taking you through the earlier procedure which was there. But if we just look at the few significant differences which were there in the faceless assessment scheme, which was prevailing before 1st April 21 and which got effective from 1st April 21, few significant variations are there. Earlier, asking for the video conference hearing, the term used in the act is personal hearing, but personal hearing is not is only through a video conference hearing. This hearing was discretionary for the authorities, and that also with the approval of the Principal Chief Commissioner of the Regional Faceless Assessment Center. And if not convinced, there was a power given to the Principal Chief Commissioner to reject the request for the video conference hearing. Because of which there were various case laws, various courts, they passed some decisions wherein they decided the orders cannot be passed without giving an opportunity of being heard. It is a gross violation of the principles of natural justice, because of which this amendment in 2022, video conference hearing was made mandatory. If as a taxpayer, as an assessee, in response to the show cause notice, I make a request to the authorities for a video conference hearing, authorities are mandated to give me that hearing. So this was one of the significant change. Regional Faceless Assessment Center as an authority was abolished. Again, after National Faceless Assessment Center, we had a regional faceless assessment centers, and under regional faceless assessment centers, we had various assessment unit, verification unit, technical unit, and review unit. Practically, probably the regional faceless assessment center as an authority was not serving much of the purpose, so probably they have abolished this thing. And one more significant change is deletion of subsection 9 in section 144B. If we look at the entire section 144B, subsection 9 earlier provided that if any assessment order is passed, I'm just reading out from the wordings of the law. It says, notwithstanding anything contained in any other provision of this act, assessment made under subsection 3 of section 143 or under section 144 in the cases referred to in subsection 2, other than the cases transferred under subsection 8 on or after the first day of April 21, shall be non-est if such assessment is not made in accordance with the procedure laid down under this section. So if tax authorities are violating or not following any procedure which is given in section 144B, it was provided in the law that such violation or such non-compliance in terms of the procedural requirements by the tax authorities can make entire assessment null and void. Definitely, if I'm a tax professional, if this provision is benefiting my client or any taxpayer, I will definitely try to use this as an argument. And this led to a lot of litigations wherein various cases in the various courts caused various cases wherein there was a lapses in terms of the procedural lapses in the proceedings, and because of which this entire subsection is deleted. And so what does it mean? That even after that, if there is any small procedural lapse in the proceedings, that will not lead to the quashing of the proceedings. Probably courts may still be considerate towards the tax authorities, and the assessment order may still hold good. This is as far as the brief background of the thing. There are two more specific changes which were introduced in the 2022 amendment. One is earlier reassessment proceedings were not a part of the faceless assessment proceedings. Now even reassessment proceedings were also made a part of the faceless assessment proceedings. And the observations of the review unit from the earlier provision appears to be binding on the assessment unit. Now it is made discretionary. Now, as a taxpayer, if there is any observation from the review unit, if assessing officer sitting in the assessment unit is not convinced with the observations of the review unit, he can make relevant observations in the proceeding sheets, records, and he has a right to deviate from the observations of the review unit. I think this is just again a quick recap of what we have seen just now after the introduction of the Faceless Assessment Scheme. Section 143(3)(a) was the section which has enabled government to introduce a Faceless Assessment Scheme, under which e-assessment scheme of 2019 was introduced. The main objective of the Faceless Assessment Scheme that taxpayers should not be aware about who is the assessing officer who is doing his assessment. We all know there are some reasons attached to it, because of which government wanted to eliminate the interactions and connections or physical interaction between the taxpayers and the assessing officers. So there is a complete elimination of the human interface, which has led to greater efficiency, transparency, and accountability of the income tax departments. And practically, I have worked on various faceless assessment proceedings. I have actually seen the level of questioning from the tax authorities, the application of mind, and the rationality of the orders passed has improved significantly in last few years after the introduction of this scheme. The idea is to have a team-based assessment, just to have a dynamic jurisdiction. Nowadays, things are quite complicated. One assessing officer may not be an expert in all the industries, all the provisions of the law, all the concepts. So there is a team-based assessment wherein there will be various experts who will be sitting in the technical unit, be it an accounting expert, be it a forensic expert, maybe a transfer pricing expert. Currently, transfer pricing is an out of faceless assessment regime, but there are various experts which will be sitting in the technical unit who will be giving various inputs to the assessing officer sitting in assessment unit. If assessing officer want to have get done any verification, there are various officers sitting in verification unit will be doing the various verification as required by the assessing officer. Again, we are not getting restricted only to the judgment of the one officer. Once an officer decides or takes a particular decision on a particular matter, this decision of the officer is subject to review or may be subject to review, because once the officer decides, the matter goes back to the review unit, goes to the Faceless Assessment National Faceless Assessment Authority, and thereafter NFAC may take a call whether this particular order needs a review from the review unit or it can be directly shared with the taxpayer. So because of all this mechanisms, all these initiatives, it has actually improved the quality of the assessments. If we just see the assessment orders which we are getting now are quite rational. Personally, I have seen there are various cases even after introduction, or not only various cases, I would say lots of cases, even after issuance of the show cause notices, proposing very high amount of disallowances, high amount of additions, when you are able to provide your submissions and you are able to convince the authorities in the hearings, authorities are not proceeding with the adjustments. They have actually discontinued, they have actually passed clean orders even after issuance of the show cause notices. So that is the kind of a shift which we have seen in last few years in terms of the faceless assessment. And in terms of the exclusions, since faceless assessment scheme was introduced for the first time for all the taxpayers, definitely all kind of cases cannot be handled through faceless assessment regime. So all the cases which are in the central charges, largely cases having a search and seizure cases, and international tax charges, which also includes transfer pricing cases. Currently, these cases are out of the faceless assessment regime. The target date to include these cases under the faceless regime is 31st March 24. So probably by the end of this financial year, we will see there will be some mechanism or some rules or notification from the CBDT, which will include these cases into the faceless regime as well. Currently, international tax cases and transfer pricing cases are out of faceless regime. Before we actually proceed on discussing on the practical issues, let's first understand the basic structure. As of now, I have included the only structure which is prevailing as of now under section 144B. I am not discussing the procedure which was there earlier, though it is relevant in some context, but we will see as we proceed further. Once the case is selected for the assessment, NFAC will assign the case to a assessment unit. Once the case will be assigned to the assessment unit, NFAC will intimate the taxpayer to complete that the cases will be completed as per the procedures of section 144B, and they will serve the notice under section 143(2) and 142(1). 143(2), all of us know, is a notice through which the assessment is initiated. 142(1) is the section under which any information required from the taxpayer is called for, which is required to complete the assessment. Thereafter, assessment unit will request NFAC to obtain additional information. Assessment units, assessing officer sitting in assessment unit will review all the information which is available in the form of income tax return, which uploaded online. And post review of that information, they will ask for any additional information which will be routed through NFAC. If assessing officer feels that there is a requirement to conduct an additional inquiry, he may request NFAC to do such inquiries, which NFAC will pass on to the verification unit. If assessing officer want any support from the technical unit on any technical topic, accounting, forensic, or valuations, or XYZ, whatever is required by the assessing officer, they can always take a help of technical unit. But every communication between assessment unit, verification unit, or technical unit, or with the taxpayer will be routed only and only through NFAC. So NFAC is one of the nodal agencies which will do the entire assessment, which will be one of the core communication channel for the entire assessment. All the such requests which will be passed on to the NFAC by assessment unit will be passed on by the NFAC to the respective taxpayer, verification unit, or technical unit as applicable. And once they reply, they will send back the responses to the assessment unit. Thereafter, assessment unit will take all the material on record, prepare their income loss determination proposal. Thereafter, the entire proposal will go back to NFAC again. In case if assessment unit has proposed any adjustment which is quite prejudicial to the taxpayer, the assessment unit will issue a show cause to the taxpayer through NFAC, and NFAC will again send the show cause to the taxpayer, and they will send the response back to the assessment unit. After considering response of the show cause, NFAC assessment and the unit will prepare their final proposal, and they will convey it to they will prepare a draft assessment order which will be shared again with the NFAC. On this draft assessment order, NFAC may decide whether this order or proposal of the tax authorities needs a review from the review unit. If they decide based on the entire allocation mechanism, the order needs a review, the review unit shall conduct the review and send it back to the NFAC. These review observations will be again shared with the officer, and officer in assessment unit, as I just discussed some time back, earlier observations of the review unit were appearing as binding on the assessment unit. But now, if assessment unit is not convinced with the observations of the review unit, he may accept or he may reject the observations of the review unit by making appropriate reasoning and prepare draft assessment order accordingly, and send the same to the NFAC. Now, definitely, there is a slide of again our regular procedures comes in place. If we have a case of international assessee or foreign companies where, or there is a transfer pricing adjustment involved where the provisions of the section 144C, which is more in the nature of the dispute resolution panel, are applicable, the procedures of the draft assessment order will be followed, and all the natural procedures will come in. If there is no transfer pricing assessment, NFAC will issue the final assessment order to the assessee with the required penalty notices and notice of demand. And definitely these are all regular provisions which are again part of the faceless assessment scheme. If any taxpayer fails to comply with any notice under section 142(1), NFAC will convey the same to the assessment unit, and the assessment unit will decide accordingly. And if any eligible assessee files observation before any objections before the DRP, NFAC will intimate the same to the assessment unit, and accordingly the orders will be kept on hold, and order will be passed once the DRP directions are received by the authorities. So just a very quick comparison, what has changed from the earlier assessment scheme and now the faceless assessment scheme. The selection of the cases and the use of the technology was very minimal in the earlier system, where majority of the cases were getting selected manually with the limited involvement of the technology. Now there are various risk parameters which are available in the system. There are various mechanisms which are involved in the system, because of which the cases are getting selected from the for the purpose of there are various selection parameters which because of which the selection is done by the tax officers. One may see this is something, some discussion in some discussions with the tax authorities. I am told, I'm not sure how much true it is, that as of now, as we file our tax return, there is an artificial intelligence and some machine learning mechanism which works at the back end, where the taxpayer, where the tax authorities are able to reconcile your tax returns, or there is some automatic reconciliations which they will prepare, and they will identify the natural questions which are applicable in your case. So nowadays, if you see in terms of the faceless regime, when we appear for the when you see the notices received from the tax authorities, even the basic notice under section 142(1), these notices are quite customized to your return. One looks at the notice, one feels that this is a customized notice wherein the assessing officer in the assessment unit has actually gone through your records and he has prepared the notice based on your records. Maybe true, assessing officer would have gone, but what I'm told by some of the officers, there is some mechanism which is working at the back end, wherein your income tax return is getting reviewed by the artificial intelligence mechanism which are introduced by the government, and even the notices are getting generated based on this mechanism. So probably I think we should appreciate that this is the time where income tax department is much ahead in race as compared to the taxpayers. Earlier, there was a territorial jurisdiction. Your case will be assessed by the one tax officer who is sitting in your jurisdiction. Now, as we have just discussed, it's a dynamic jurisdiction with the faceless team anywhere in the country. Face-to-face meetings and cautioning were definitely a history for were a very regular feature for all of us, wherein we used to go and we used to discuss the case with the officer. Now, no physical meetings with the tax officer. Identity of the tax officer is not known to us. Quality of the decisions, as we discussed, it has improved significantly. Flexibility, definitely with the physical interaction, you have a lot of flexibility to discuss it with the tax authorities and takes relevant timelines. And in the faceless regime, you have stricter timelines, but still there are various occasions on which you can definitely ask for the extension. I have not seen till date, unless and until it's a very time barring case, tax authorities, even under the faceless regime, are denying the request for adjournments for any silly reasons. As we know, the tax department is getting more tax savvy and more vigilant on all our actions. As a taxpayer, we should exercise some precaution. All of us are very tax savvy and very much keen on using social media for our profiling. One has to be very cautious. If you are posting any purchase of new car, BMW, Mercedes or Audi on the social media, you have to be mentally prepared. Some notice coming from the tax officer asking source of this information, because your information is getting tracked much more than what you know about them, about yourself. I was interacting with one of the very senior officer in Delhi, and the officer very categorically told me कि आपकी सारी information हमारे पास है, वो information आपके पास है कि नहीं वो आप check कर लीजिए. So you must understand the level of information and the level of technology which they have actually involved in the entire tax function. So social media profiling, and even one has to be very cautious when you are going for the overseas trips. Even the overseas trips are getting monitored, and they will also like to ensure that if you are going for the overseas trips, what is your income level, whether your income level really justify these kind of trips or not. Audit trail of all high value transactions. We know that now there is a lot of reconciliation data synergies which is there with various authorities, various banks, various reporting which is done by the various sources. So this data integrity, data integration is very important in today's time. There is a lot of exchange of data between the authorities, and autofill, pre-fill tax returns is there. Lot of data analytics is actually implemented by the income tax department in their analysis. One can see there is a reconciliation of the sales as per the GST records, reconciliation of the income as per the TDS credit reported in Form 26 AS. There is a new mechanism which is coming in, annual information statement. We all know annual information statement. If anyone has not looked at the annual information statement, I'm sure all of you would have looked as a chartered accountants, but the amount of data it carries about you, all your majority of the transactions are available with the income tax department. So at this point of time, probably everything what you do as a transaction is available in the public domain. Reconciliation of the clause 34A, clause 44, when it comes to tax audit report. Just one word of caution here. I have seen various tax audit reports, various tax auditors give a remark in the tax audit reports that because of the voluminous data, they are not able to perform the clause 34 reconciliation. Clause 44 reconciliation is not possible because of the sheer volume of the data. These things are getting tracked now. If you have any qualification or any disclaimer in your tax audit report or any audit report, be it from CCB or any audit report or a 10 CCB you are submitting for claiming any deduction, these things are getting tracked in the system, and authorities are checking if there is any qualification. They will come to, there will be some notices. Practically in one of my clients, when clause 34 reconciliation was not provided because of the volume of data, they received 263 notice simply because of this particular point. Because clause 34 reconciliation is not provided by you in the tax audit report, please provide that reconciliation to me at this stage now. And all of us know, if data is difficult to get after the end of the year, it is always difficult to get the same data after 2 years when the authorities are there at our doorstep. Reconciliation of expenditure, TDS and the financial statements, TCS, TDS on the sales and purchase of the goods, Form 15 CACB. So everything is there in the public domain with the department. Now, if I just see the experience so far in terms of the entire faceless assessment regime, the queries are very targeted, very focused. They will, you should be aware about what all information is there in public domain. Practically, I dealt with one of the case wherein assessee was claiming a tax holiday for one of the unit, and a company has disclosed only one unit in the books of account. Officer was having a data from the GIDC, and from the GIDC records, they identified that company has 2 premises. And from the reconciliation of the data of the GIDC, officer questioned the tax eligibility of the assessee for the purpose of the tax holiday, that you already had a unit 1, your operations are there in unit 1, and you are claiming the tax holiday in unit 2. Please justify how you are eligible for the claiming tax holiday in the unit 2. And probably this was something which would have led to reopening of the earlier assessment years. Fortunately, taxpayer was having all the records. Unit 1 was closed for a number of years. It was only just appearing on the GIDC records. Unit 2 was actually eligible for the purpose of tax holiday. When we made all the submissions, fortunately, there was no adjustment in the final assessment order. But just imagine the amount of data mined application which now tax officers are doing, as we have seen in the traditional assessments. Submissions, quality of the submissions, accuracy of the submissions is the key. Definitely, when we are appearing before these authorities now, unlike earlier regime where we used to get multiple opportunities to meet and discuss the case with the officer, now you get only one window. After you have filed a response to the show cause notice, and if you make a request for the video conference hearing, you will get one window. And I have seen the amount of preparedness which these officers also do before they are coming for the assessment or the hearing. You must be prepared that officer knows each and every point which is there in your file. He would be having each and everything available with him. Probably more what you may not be aware. So if you're going for the faceless assessment hearing, be aware about all your submissions, be aware about all the information which is there in public domain about your client, because take it for granted, officer knows everything, whatever is there in the public domain. the amount of questions, the quality of the questions is far better than what we have seen in our traditional assessments. Definitely, sometimes you have experienced the timelines provided by the officers are quite crunched. But if the cases are there where we have a reasonable time is available for the completion of the assessment, and if we request for the adjournment, in majority of the cases we have seen they are not so rigid and they are quite cooperative in giving the adjournments. So I think this is still not a very big concern. At least I have not seen this practically in my clients. And definitely consistency of the tax positions has come across. As we have discussed various cases, various experiences of my clients. Earlier, it was the reality, or probably we have observed that once the show cause notice is issued by the officer, any submissions we make, in majority of the cases, we used to end up in getting the disallowance or an adjustment. Now, probably I have seen a significant change in this approach, wherein even after issuance of the show cause notice, if you have given a quality submissions, if you have convinced the officer, if you have a good case before the officer, in majority of the cases I have seen, officers are not making, unless and until it's a case or it's a gray area, officers have not continued with the adjustment in the final orders, which is again a very good thing and a big respite to the taxpayers. I think majority of this we have largely covered. Now, in terms of the readiness for the taxpayer, because this is the time where we are saying that tax authorities are way ahead as compared to the taxpayers. The amount of data reconciliation which we should have, what we are doing for the purpose of clause 44, 26 AS reconciliation, those reconciliations has to be available with the taxpayers, because there is a lot of technology available with the department. Probably taxpayers can adopt some technologies to do these reconciliations, proactive and timely preparation, because the amount of time now is for the purpose of assessment is anyway truncated. So definitely one can look at the various ways to be assessment ready, prepare all your backups, all your supportings at the stage when you're filing your tax returns, when you're doing your compliances. We all know from the practical experience, anything which is difficult to prepare at the time after the completion of the year may be more difficult when we are preparing it at the time of assessment. Quality of the submissions is definitely a key, and your digital readiness is definitely something which will make a lot of difference when you're dealing with these officers. This is something which, if we are ready with these kind of things, it may help us in preparing us or probably saving our clients from a lot of penalty exposures. Now, probably this is one of the important amendment which is introduced in the 2022 amendment, wherein subsection 9 is removed from the statute. This subsection 9, as we discussed, I have just read, it has provided that the officer has to follow the procedure, and if the procedure is not followed, the entire order may be treated as invalid order. And there are various judgments of the Delhi High Court, wherein in such cases assessments were set aside because of the non-adherence of the prescribed procedure under section 144B. Now, after this deletion, there is a Supreme Court decision, I think, there is a Supreme Court decision in the case of Mantra Industries, wherein Supreme Court has remanded back the case to the High Court to relook at the entire decision, whether post amendment of subsection 9, of deletion of the subsection 9, whether same position will continue or not. Now, one may wonder that post deletion of subsection 9, is the stand of the department or stand of the courts is that even if there is any procedural lapse in the conduct of the assessment proceedings by the assessing officers, probably we are giving a leeway to the tax authorities on their own mistakes. I would try to read it a bit rationally. Somewhere I think we have to bring the element of principles of natural justice. If any violation of the procedural lapse or any procedural lapse leads to the violation of the principles of the natural justice, in my personal view, those cases will still be considered rightfully by the authorities? Yes, but as a taxpayer, as a tax professional, we are always very innovative in devising various arguments, looking at the various loopholes in the submissions, in the procedures by the tax authorities, and we take various technical grounds because of which on technical grounds many assessment orders get quashed. I think probably those are the cases which will get prevented under this amendment. But yes, if there is any violation, some important submission not considered by the taxpayer, definitely it will be should get a leeway under the principles of natural justice. I think probably I feel still the litigation on this particular issue will definitely continue. Just a minute, I think I'm not. So these are the cases wherein the personal hearings were not provided by the tax authorities, and cases courts have taken a stand that in these cases the cases has to be demanded back to the authorities. So definitely, if your submissions are not considered correctly by the tax, so if your cases are not considered appropriately by the, if your submissions are not appropriately considered by the authorities, definitely you get a lot of leeway under these decisions. There is a specific case of KR Shroff from the Gujarat High Court, wherein in such cases VC got abruptly terminated, and even after that assessing officer ended up in passing the assessment order. In that case, the court has actually quashed the order, but I feel probably in majority of the cases courts are now getting quite reasonable with the tax authorities also, and they are setting aside such cases and giving tax authorities another chance to rectify these mistakes and pass reasoned orders. Again, some procedural things which one should always be mindful, which may give us some leeway when the case is quite technically weak, like the appropriate DIN has to be used for the purpose of issuance of the orders and notices. And there are decisions wherein even if the DIN is not available, courts have decided to treat such cases as null and void. Some issues which we have faced practically on the ground when we are dealing with these cases. In the initial days, these notices, when they were issued, they were quite exhaustive and quite open-ended. Like in such cases, in some cases, they ask for the large number of details, such as bank statements for all the 12 months for all the bank accounts. In the large multinationals, even in the companies which has a turnover of around 500 or 600 crore, this may be a very voluminous data for any company to provide. Orders are there are various orders wherein return is accepted with the same return of income, but there are a lot of mistakes which are there in the compilation sheets, wherein the tax credits or TDS credits are denied. But I think it's a regular feature which we have also faced in the traditional assessments. Notices issued, we have just seen this gives one technical argument to the taxpayer to get the proceedings quashed. But now I have seen department is very cautious and very careful in such cases, wherein they are ensuring that DIN has to be available for any order or any notice which is issued to the taxpayers. In some cases, I think this point we have discussed, where if various cases we are filing the grievances, if the response is not received, definitely CPE can be explored. In various cases, draft assessment order is not issued by the authorities where it is eligible for the eligible assesses. And if these draft assessment orders are not issued and only the final assessment orders are issued by the authorities, it leads to the violation of the principles of natural justice, wherein the one of the option available to the taxpayer, that is either going to DRP or CID appeal, is taken away, and taxpayer can definitely take this as an argument. And there are a number of decisions of the Bombay High Court or Delhi High Court wherein on non-issuance of the draft assessment order, the entire proceedings are quashed. In some cases, assessment orders are passed before the due date of submissions are over. This is very regular feature wherein many times notice get uploaded on the income tax portal, but there is no real-time alert. In such cases, can we assume that this real-time alert not provided, even after this real-time alert is not received by the taxpayer, the notice is validly served? In the case of Sumanjit Agrawal, Delhi High Court has held that once the notice is uploaded on the portal of the taxpayer and taxpayer has not seen the notice will be considered as served on the taxpayer on the date on which the taxpayer actually opens the login and actually looks at the notice. So for all practical purpose, this may be the date, but yes, in terms of the compliance, if you miss the compliance timeline, officer may end up in passing an order that litigation route may be open. So as a measure of good practice, one has to monitor his income tax login on a daily basis, just to see if there is any notice or any non-compliance which is there or not. In many cases, notices are sent to old or discontinued email IDs. Many new due dates have fallen on the public holidays and weekends, and we have spent our days in preparing those submissions. A lot of voluminous data gets prepared. I think this is all largely I have covered. And if I just couple of more practical points, which I would just like to keep as my view personally, still though subsection 9 is deleted, but if as a taxpayer, if you want to get the communication between a review unit or the assessment unit, whether the assessment unit has rightfully followed the observations of the review unit, as a taxpayer, we should have an access to that. Probably if someone wants, probably someone can request for the data. If some procedural lapses are still observed, some principles of natural justice are still violated, one can have an additional argument. And last, I would like to close with this. When it comes to appearing for the hearing for the faceless assessment, one has to be very well prepared, because the level of preparedness which is there with the tax authorities is really very high. And I think that one window, if you are able to convince, and I have practically seen the officers, if they get convinced, they are not continuing the adjustment proposed in the show cause notice in the final assessment orders. So this is, I think, is a one big opportunity available with all taxpayers in today's time. One has to be very well prepared for that. With that, I'm happy to take any questions.
Sir, we have one question.
Yeah. I think I'm not able to see the chat box, or is there?
So now I'll read out for you.
Yeah.
The question is, I purchased a flat from the site owner out of his share of area given to him by the developer of the land and a development agreement. Now the site owner is of the view that there is no GST on the flat being sold to me by him out of his share. Is that stand of the site owner correct one?
Ashita, I would be happy to answer this question, but I am not a GST expert, so I would probably.
So that's all. Yeah, maybe for the next speaker,
I
sir.
think Amish Bhai can take this question well.
Yes, yes. So though we are done for the questions.
Great. Thank you.
Living in a state of gratitude is the gateway to grace. The way, sir, you have taken us through the entire topic is highly commendable. I, on behalf of ICAI and CPE Committee, take the pleasure to thank you for your valuable insights that you shared with our participants today. All good things have to come to an end, and so does this session. But an end is beginning of next voice. On these lines and setting our benchmarks higher, let us move to our next session. I would like to invite my co-moderator, CA Yash Shah, to take the proceedings further. Thank you and namaste. Over to you, Yash.
Thank you so much, Prashant Bhai, for this wonderful deliberation. Uh, moving
Thank you,
on to
everyone.
the next session. Thank you all for your staying back for this second session. We will immediately start with the second session, which is on GST issues in real estate sector, including works contract and government contracts. So GST after 1/4/2009 has not been the same, because then came the drastic notification, which we all are aware, notification 3/19, which changed the taxability of the real estate sector tremendously. So for deliberation on that subject topic, we have a very eminent faculty with us, Mr. Amish Khandar sir. So Amrish sir, good afternoon. Welcome to today's webinar, sir.
Yeah. Good afternoon to all. Yeah.
Yes, sir. So I would like to briefly introduce Amish Kandar sir. He is in practice since 2003, and his area of practice is service tax, GST, strategic planning and management advisory. He is presently the special invitee member of Audit Advisory Board of Principal Directorate of Audit Controller and Auditor General at Ahmedabad. He is declared as top 10 eminent GST consultants in India for the year 2018 by Insight Success. So welcome you, sir, on this panel, and the floor is all yours, sir. Over to you, sir.
Yeah. Yeah. Thank you very much, Yash, for kind introduction. And I thank the CA Institute and CPE Committee, Purushottam Bhai, and all you office bearers for inviting me to share some of my thoughts on GST on real estate sector, which is also a kind of burning, because infrastructure is going up across India in such a way, and based on that there are ambiguities, there are misconceptions, there are simplification also in some of the cases. And for that, this is real estate sector, works contract, and government contracts are the sectors or the points which most of us consultants come across day in and day out. And hence I picked up this, rather your committee has picked up the right subject, and I am really privileged to deliver. Let us take through the journey on real estate sector in GST. So, this presentation is audible, right? I think.
Yes, sir, it is visible.
Sorry, it's visible and audible, my voice also. Okay, thank you.
Yes.
Yeah. So earlier there used to be, as we all know, there used to be various kind of laws like excise, service tax, VAT, CST, and all that, which has got merged. And now GST has come. This is the slide about COVID-19, that what are the sectors who have benefited or who had suffered a lot. Like it starts from tourism to aviation to automobiles and so many other sectors. And the sectors which benefited a lot are personal healthcare, food, and ICT and medical support services. So these are the sectors wherein it helps us to concentrate. But I think things have changed a lot after COVID. Construction and real estate sector, which was not so prominent during the COVID time, has gone up by leaps and bounds. So what the contents that I am planning to take in 45 minutes around, and next 10 minutes will be question and answers if there are any. So taxability under GST till 31st March 2019. So from the introduction 1717 to 31st March 19, taxability post 1/4/2019, taxability of TDR, FSI, and long-term lease. And there are so many participants across India, and hence I believe that there are various problems in transferable development rights, floor space index, that is an additional permission to construct more based on the FSI that we get it from the municipal corporation. and long-term lease is a problem now based on Gujarat Industrial Development Corporation, Maharashtra Industrial Development Corporation, resale is, there are a number of SOCOs issue notices which have been issued, ITC reversal norms under Rule 42 and works contract services. So one of the very important point which we all know by and large, because now it has been almost 6 years that on 1st of July, then we will celebrate completion of 6 years of GST. So in earlier regime, the definition of sale of the definition of exclusion in service tax was sale of an immovable property. So immovable property has a wider meaning. So it includes land and any accruals out of land. However, in GST now it is made exemption is under Schedule 3 is only sale of land. And that is a big problem that litigation has already started in number of cases, which will travel up to Supreme Court at least, because sale of land is only exempted in GST, and hence like transferable development rights or any rights of land which till service tax regime was not taxable has become taxable in GST. And so many people, so many consultants or the trade and industry were not that aware, or they didn't envisage. And many transactions happened based on that assumption that, okay, sale of land is exempt and hence any kind of TDR or FSI or long-term lease is also exempt. However, it is not so. Though it is a litigative issue, but at present, number of cases, thousands of people or trade and industry have received SOCOs, so we have to fight it out based on the merits. It will be decided. But however, as a consultant, what stand we should take, that we will discuss later on in the later part of my lecture or later part of my slides. So this, we all know that sale of land is not taxable. Sale of building, if it is received, sale of building, if it is any kind of consideration is received after completion certificate or BU, then it is not taxable. But if even a single rupee is received before BU, then it is taxable naturally. And the example that we all know, very simple. So GST will be levied in case wherever any amount is received before BU, that is 50 lakhs that we have to pay. Changes in real estate sector and works contract in 47th GST Council meeting. So one of the very, very important and one of the very impactful change has brought in is GST rates has been increased from 12% to 18% on works contract services of roads, bridges, railways, metro, effluent treatment plant and crematorium, etc. And central and state governments, local authorities for historical monuments, canals, dams, all these canals and dams and roads were exempted in service tax regime. It was not taxable. However, from 1/7/17, it got taxed at the rate of 12%. And now it is, because when it was taxable at 12%, there was an inverted duty structure, IDS was there, and we were getting the refunds also of all these kind of projects, because while we construct roads or bridges or canals, our output tax rate is 12%, whereas input tax rate, like most of the rate will be 12 or 18%, and cement would have been at 28%. So there was an inverted duty structure, and for that we were filing refunds and we were getting. However, from July 2022, this change has come in 47th Council meeting, and GST rates has been increased from 12 to 18%. So there will not be any case of inverted duty structure case now. However, at the same time, the very conflict point has come between all these kind of departments and the trade and industry is there. Suppose there is a 400 crore project, out of which 150 crore has already been built when this rate was 12% and now it is 18%. So what is happening is that the builders or the works contractor would have taken into consideration the 6% arbitrage, and then they would have filed a tender. But now, since now it is increased from 12 to 18%, so many trade and industry people have started approaching to the government or the local authorities that, okay, now the rates have been increased and please compensate. So that those kind of all files and all matters are pending before government. Some of the government departments are taking it positively that, okay, any additional tax burden can be claimed from the government, and that was those kind of lines or conditions were there in tender, and based on that they have submitted their claims before the government or authorities, and therefore they are clearing depending upon their calculation and their whatever amount is due. However, wherever those kind of conditions were not there in the tender, there even conflict has started. The people have approached high courts also. So then time will tell that what would happen in those kind of things, because out of 400 crore, 150 crore is billed, and 250 crore has to be billed based on 18% GST. So that is a conflict point, but that is for the transition period. And I think government also will consider, rather all the departments of government, that, okay, here the works contractor are genuine, and since rate has been increased from 12 to 18, we should pay. Now, if you see that service description, service recipient, GST rate up to 31st March 21, and from 1/1/22, GST rates are there. And if you see the last one. So composite supply of works contract by way of construction, repairs, and all that. 1 minute, not been. So composite supply of works contract by way of construction, repairs, maintenance, and all that. We can see the rates from 12 to 18%. It has been increased. The second line is composite supply of works contract provided by subcontractor to the main contractor, where the main contractor is providing services specified above serial number 1 to the specified service recipient. There is a change from 12% to 18%. And third one is, we can see from 5% government or local authority to 12%, it has been increased. And the last one also, it has been increased from 5% to 12%. So these are the changes, but we will all have to keep this in mind, because whenever the departmental audit will happen, we will have to submit all these different rates and their respective ITC, and whatever changes in rates have been done. At the same time, we will have to claim from the government or the various departments of canals and roads, bridges, etc., from whom the tender or the works contractor would have got. This is clarification on taxability of preferential location charges. It is a welcome step that industrial plots or plots for development of infrastructure for financial business provided by the state government undertaking and any other entity having 50% is the GST rate is nil, and this is the long-term lease of land and shall get the same treatment under GST. So that is an exempt, that is a welcome step by the department. And rental or leasing services involving on or leased residential property is 18%. So this is a welcome step taken in this GST council. The next is classification on taxability, clarification on taxability on plotting, sale of developed plot which basic amenities like drainage lines, etc., shall be considered as a sale of land and hence not taxable under GST. There is a great level of controversy over here. If we see this plotting case, the Gujarat AAR, Authority for Advanced Ruling, has given has given a verdict that it would be taxed at 5%. However, AAA given the verdict that it will be taxed at 18%. And Gujarat High Court in the case of Munjal Bhatt gave the benefit that, okay, if there are basic amenities and with some specific conditions, if there is a plotting of land, then it will not be taxed because there is no value addition in the eyes of the Honorable High Court. However, there are various courts judgments also, and hence it has to be seen very seriously that if there is a parcel of land which is divided into maybe 50 plots, and those 50 plots, there is a not basic amenities, but along with basic amenities, there is a clubhouse, there is a swimming pool and gym and tennis court and all other kind of facilities which happens normally in this today's time. All this kind of luxury or the kind of entertainment infrastructure is there, then it cannot be considered that, okay, that this is having only basic amenities along with the normal land, and hence it should not be taxed. So in that case, there is a possibility that department will look at it with different angle, that this is not normal plotting, this is plotting with amenities or the luxuries, and hence department as per AAR on entire amount 5% or 18% has to be charged. However, there are a couple of solutions which could be worked out. Like there could be two companies. One is for development of infrastructure, and which is a works contract carrying activity in which ITC will also be available. And there will be only sale purchase of land and sale of land. So that company will not be required to take any registration under GST. And the second company, which does infrastructure development, will take registration and will discharge the liability, whatever infrastructure development charges it would have collected from the plot owner. But the benefit will be there that the purchase and sale of land is not liable to GST. So that kind of tax planning within four corners of law is also possible. These toll charges and all that, no GST will be applicable. And this is the construction sector under GST that we know from the starting of GST 1717 to 31st March 2019. There was construction of residential and commercial complex. Applicable rate of service tax was 15% and abatement was 17%. Under service tax, there is a works contract on which service portion in execution of works contract, full service tax, that is 15, full rate 15% was applicable. Total amount in case of original work 6%, and total amount in case of maintenance and repairs. So 30% was abatement and 70%, that means 10.50% was taxable. This is the story of service tax. However, in GST, it is quite simplified. Taxability of construction related service under GST, if we see works contract service, GST will be chargeable at the rate of 18% with ITC. This is the slide from 1717 to 31st March 19. Residential complex 8% and 12% with ITC, and commercial complex 12% with ITC. So that is available. Now, if you see the taxability of GST on various charges collected by builder, if we see the subscription charges, booking fees, administration fees. So GST rate for residential unit before 1419 and for old option after 1419, and commercial units it was 12%, and after that it is 5% and 1%. PLC, floor rise and parking charges, legal charges, various are taxable at the rate 12% and 5%. Customer advance for flat office 12 and 5. Other miscellaneous charges same. Common infrastructure development charges like road, fire safety, street light, playground, composite supply will be 12 and 5% each. Club development charges, internal development charges, external development charges 12 and 5. And those kind of maintenance deposit will not be taxable. Stamp duty and registration charges are government duties, and tax on tax is not possible. So that will not be taxable. membership of club, because so many townships are offering membership of clubs, that would be taxed at 18%. Charges for cancellation of booking, if there are any separate charges because of the cancellation of booking, then it will be taxed at 18%. If there is extra civil work charges, that means if I have purchased a residence or an office and I want some modification, after the conveyance deed has already happened, and on conveyance deed I have discharged my stamp duty and applicable GST rate, maybe 5% and 12%, and now I want some changes in my home or office, and for that extra civil work or extra work is I have told the builder or the developer to carry out, and on that amount 18% will be applicable. And interest on late payment, only if actually collected, it will be considered to be composite supply, 12% and 5%, or 1% in case of affordable residence. Applicability of GST on various charges collected by society. We all know 7,500 per unit per month is exempt. So if there is a residence welfare association, then only the 7,500 will be available exemption. So please note that if I have 100 flats or 100 bungalows in a society and my total collection is 40 lakhs, which is more than 20 lakhs. However, even though it is more than 20 lakhs, but per unit my collection is maybe 6,000 rupees, then it will not be taxable, because Resident Welfare Association per unit 7,500 is applicable. So even though it is more than 20 lakhs, 40 lakhs is the total collection, but it will not be taxed. But in so many townships, there are private limited companies also, or maintenance development companies are there also. In that case, this 7,500 exemption is not available, because it is only applicable for RWA. Construction sector under GST, as we discussed, after 1/4/2019 onwards, is these project types: real estate project and residential real estate project, RREP and REP. So if carpet area of commercial apartment is more than 15% of total carpet area, then it will be an REP project, which may include entirely commercial project, commercial plus affordable housing, commercial plus non-affordable housing, or affordable plus non-affordable plus commercial, all put together. But please take care that this is more than 15% is the commercial area of the total carpet. In RREP, it is less than or equal to 15%, not more than 15% of the carpet area is commercial. And hence it can be affordable, non-affordable, affordable plus non-affordable housing, or affordable housing plus commercial, but less than 15%, non-affordable plus commercial, or affordable, non-affordable plus commercial, but less than 15% will be there. So in that case, earlier the rate was 8%, which has now been, after 1/4/2019, then it is 1%, and 12% RREP is there. It is going to be 5%. So what has happened is, actually the rate was 12% for commercial and residence before 1/4/2019, and the ITC was allowed. However, since there was, what happened is that there were so many people who complained to the government that we are not getting the benefit of ITC, which is allowed to developer. And looking into that question by the public at large, the government decided that we need to lower down the residential sector rate. So they lowered down to from 12% to 5%, and the ITC, which was otherwise allowed, now it is restricted. So in that case, if there is an affordable less than 45 lakhs is the amount of conveyance deed and 90 square meter, then it is 1%. Otherwise, all residence project will attract 5% without ITC, and all commercial projects would attract 12% with ITC. So that has to be seen. Now coming to this, carpet area of commercial apartment is up to 15% of total carpet area. The affordable housing is reduced now from 8 to 1, 12 to 5%, non-affordable housing. And mind you, this red color is there, commercial units 12% and 5%. So let me give you an example in this case. that I have a scheme of 80 flats and there are 10 shops on the ground floor. And the cumulative carpet area of those 10 shops is not more than 15% of the total area of that entire building, which is residence plus this commercial. The total commercial area is less than 15%. So in that case, even though those 10 shops are commercial in nature, but now that entire project is to be considered as RREP, and those 10 shops, whenever the developer or builder sells in the market, he will have to charge only 5% and not 12%. This distinction must be taken in our record or our mind, that this, even though it is 10 shops which are commercial units, but those 10 shops will be taxed at 5%, and there will be no ITC allowed of the entire project because entire project is RREP. Now suppose I have a 100 flat scheme and I have 40 shops also, and the cumulative area, carpet area of 40 shops is suppose 20%, which is more than 15%. In that case, what will happen, that whatever is the residential project, maybe if this 20% is commercial, that means 80% is residential area. So those 80% residential area flats will be taxed at 5% without ITC. And the commercial units, that means in my example, 40 shops will be taxed at 12%, mind you 12%, because it is more than 15%. And those 40 shops will have to bear the tax of 12%. And for that proportionate 20% commercial area, ITC would be eligible to the builder or developer. And a builder and developer will take 20%, which is commercial area, the proportionate ITC also, and 12% will be the rate, GST rate. This has to be kept in our mind. So 1/4/2019, any kind of new projects, there is only one rate that we can see is 1, 5, and 12, 1 for affordable, 5 for non-affordable, and 12% for commercial part, commercial complex, or the commercial area if it is more than 15% of the REP. This affordable residential was a lot of controversy earlier during the service tax regime, because then from municipal corporation, entire project has to be considered as affordable. So suppose 500 flats are there, and if maybe 10, 20 flats are not fitting into the definition of affordable, then that entire project would not be identified as affordable residential project under service tax from the municipal corporation, and therefore it was not allowed the reduced rate. There were so many old schemes that we can see, Jawaharlal Nehru National Urban Renewal Mission, or so many other kind of schemes, which was allowed to be considered as affordable residence. So along with that, the most important and the beneficial that after GST that they have defined 1/4/2019 on or after, that if there is any scheme which is having the value of 45 lakhs and the area is of 90 square meter or less, then that particular flat is an affordable flat, and for that 1% could be charged. So even though I have a scheme of 500 flats, which includes luxurious flats also, but out of 500, I have 50 flats whose value is less than 45 lakhs and area is less than 90 square meters and 60 square meter respectively in the tier 1 cities. In that case, this, even though 500 flat scheme may be having every single flat of 2 crores, 3 crores or whatever, but those 50 flats, since the value is less than 45 lakhs and the area is also less, it will be considered for 1%. So that is the benefit, and it is a very welcome step from the government. Conditions for new rates for ongoing projects or new projects. This is now even the departmental service tax, GST audit has already started, And in that case, so many officers are asking for the developers whether these conditions have been fulfilled for the new projects or not. After 1/4/2019, only we can pay 1% and 5% only through cash, not with ITC, because ITC balance whatever was there cannot be utilized. 1 and 5% has to be paid through cash only. ITC attributable to installments due on or after 1/4/19 shall be reversed in the manner prescribed either by this slide. We will see later on that how ITC attributable can be reversed. The most important condition is 80% of the value of input and input services, excluding TDR, long-term lease, electricity, HST, have to be received from the registered supplier only. So this is a very stringent condition that 80% of value of input and input services have to be obtained from the registered supplier. This project-wise account of inward supplies is to be maintained for supplies received from registered and unregistered supply. ITC not availed shall be reported every month by reporting the same as ineligible credit in GSTR 3B. And the tax liability on the shortfall of inward supplies from 80%, if my total procurement from registered supplier is only 74%, then for remaining 6%, I will have to discharge the liability in my output tax liability up to the June of every financial year. So this is an example that I will skip it now, but we can all see that how this illustration 1, 2, and 3 gives us an example that how many percentage is from various kind of registered and non-registered supplier, and how it will be calculated for 80%. So this is an example that we can. This is supply of such goods and services. Rate of tax is 18%, but in case of cement, it is 28%. And whatever capital goods are there supplied to a promoter for construction of a project. So this is regarding 80% if we procured any kind of goods and services from unregistered person, more than 20%. That means we are going below 80% condition. Then we have to discharge our liability accordingly, 1828 and the applicable rates. This is very important notification. Many of our consultants have also missed it in the early part of the GST. If there is a works contract service provided for construction of residential affordable apartments, then GST rate, which is normally is 18% for a works contract service, will be reduced to 12%. So what is going to happen is this is applicable only when the affordable residential apartments are not less than 50% of the total carpet area. So suppose I have a 250 flats scheme, and out of that, more than 50% of the carpet area is for affordable residential apartment, which is going to attract GST at the rate 1%. So it will attract only when the value is less than 45 lakhs and the square meter is below 90 and 60 square meter respectively. Then that particular flat will be considered as affordable housing or affordable residential apartment. And if those kind of flats are more than 50%, then in that case, the builder or developer can give a certificate or a letter to the works contractor certifying that out of our total carpet area, more than 50% is for affordable housing residential apartments, and hence you should charge us 12% and not 18%. Now, the condition number 4, in case if finally the condition of affordable housing is not met, suppose when I had projected in the earlier stage of the project that, okay, more than 50% will be residential, affordable residential apartments. However, prices go up and it exceeds the limit of 45 lakhs. And hence I cannot match the 50% condition. In that case, the builder shall be liable to pay tax on RCM basis on difference amount, that is 6%, because I told the works contractor to charge me only 12% and I paid him 12%, which he also in turn paid to the government 12%, or he utilized it, his ITC. But now, suppose I do not match that condition, then differential 6% as a builder or developer, he will have to pay under RCM. This where percentage completion as on 31st March is not 0 RREP. This is a very smart calculation. We will skip it just by having 1 or 2 comments from my side. This is a very smart calculation. Suppose I have completed 80%, but my collection is not 80%, suppose 40%, then I should be allowed some excess ITC also. Suppose my collection is 70% and my execution of work is only 30-40%. So in that case, I should be receiving less ITC. So this is an example that what kind of ITC reversal will be happening. So in this case, 8 crore minus 4.20 crore, so 3.80. This is an very smart and very logical calculation formula, which every unit will have to apply whenever GST audit will be happening at their premises. In this example, it is ineligible ITC is 5 crore, eligible is 3 crore. In this case, additional ITC can be claimed of 0.25 crore. So it is a very logical because the completion is 20% and the collection percentage of invoicing of booked is 30%. In that case, I am eligible for total 5.25 crore ITC, but I have taken only 5 crore, so additional 25 lakhs ITC I can claim. Now, coming to the point which we had seen earlier, I think it is 4:35, so I have another 15 minutes. So taxability of TDR or FSI and long-term lease. This is a very controversial point that we all discussed, that I discussed in my earlier part of the presentation. That is transferable development right. It happens by way of slum rehabilitation projects. So SRA are the projects, suppose there are 500 slums and I am given a contract or tender from the government that I have to make 500 1 BHK flats for all those slum dwellers. And for that, government gives me, maybe suppose my cost of those 500 flats is 100 crore, then government gives me 120 crore worth of TDR, which is transferable development right. That gives any builder or developer the freedom or the flexibility that they can, instead of, suppose in normal case, they can construct 7-story building, but with this TDR, we subject to other rules and regulations. Now that builder or developer can construct 10-story building. So that is the benefit of transferable development right. Those 120 crore TDR, which is a piece of paper which has been given by municipal corporation or government, can be traded also in the market for 3 times. And it has to be utilized within 9 years as per government of Gujarat law as of now. Every state has different laws for that. So every consultant or CA will have to check their state's law accordingly. So this TDR and FSI and long lease is there. How it applies, that if we see this value of TDR supplied from landowner is 10 crore, the number of flats is 100 flats, date of starting of project is 15th April 19, and the receipt of completion is 2020. And now number of, after 1/4/2019, what has happened is the amount of TDR, whatever tax is there, has to be paid on reverse charge mechanism. And hence, if the TDR is going to be utilized by a developer who is constructing residential units, then he does not have to pay any amount or any GST on TDR till the time of completion certificate or building use permission is received in that case. So here, in our case, suppose number of flats remain unsold is 20. So if this value of TDR supplied from the landowner is 10 crore, originally the tax rate would have been 18%. That means 1.8 crore the developer or builder should have paid. But on residential, it is not taxable till the time of CC. Now in this case, 20 flats, so 20% is unsold. So out of 1.8 crore, if we see 20% is 36 lakhs, the builder or the developer will have to pay at the end of the project. So, and this amount cannot exceed the applicable rate of 1 or 5%, that is 40 lakhs, which is 5% of 20 flats into 40 lakhs per flat, suppose we consider. So whatever amount of unsold flats after BU, if there is a TDR on that, 18% will have to be discharged on that. The same thing applies in case of commercial projects also. So suppose I am a builder or developer and I purchase TDR worth 25 crore from the market. Then on those 25 crore, I will have to discharge GST at the rate of 18% because GST is on reverse charge mechanism on developer or builder who purchases the TDR from the market. And in case of commercial, there is no exemption till the time of completion certificate is received, which is in the case of residential. If you have any questions, maybe after 10 minutes, you can please ask me. This is a mixed project. And if it is mixed project, then 90 flats and 10 shops and 18 flats is there. So per flat, the certain amount has to be discharged. Treatment of TDR, FSI and long-term lease for new project, residential projects, mixed projects, and taxability is exempt till the time of BU. Graphical presentation, area sharing. This is also very important because joint development agreements are happening because landowner has suppose 300 crores worth of land pocket and construction, the builder does not have 300 crores to purchase from the landowner. And as well as landowner does not have 150 crores for the construction or the know-how of the entire project construction. Hence, they join the hands and they create a joint development agreement. Sometimes it is area sharing, sometimes it is revenue sharing, and sometimes it is a genuine partnership also, and sometimes it is only affiliation. So in this case, various kind of cases, there is development rights which is flowing from landowner to developer. And we, as we discussed in my first slide, that sale of land is only exempted in case of GST regime. However, it was sale of immovable property was exempt in service tax regime. Now, since only sale of land is exempted here in our case, from landowner to developer, when whatever development rights are flowing is taking the color of transferable development right. So it is a sorry. It is a development right from landowner to developer. And since it is not sale of land, it would attract GST. Then GST attraction will be based on residential or commercial projects. It will be on a reverse charge mechanism. If residential development right will be there, it will be exempt till the time of completion certificate. If it is a commercial project, then this development right would be taxed in the hands of developer under RCM at the rate of 18%. And we would suggest to discharge on the very first day, because once suppose development rights is worth 100 crores, so 18 crores will be GST amount which will be paid by developer, and that will become developer's ITC, which developer would be able to absorb those ITC one after another booking that he would receive from the commercial project or commercial project customer. And for whatever, suppose he sells a shop for 1 crore, so 18 lakhs is his liability, which he collects from the customer. And those 18 lakhs, he can pay it from the ITC, which is generated through purchase of development rights from the landowner. So this is an area, in some of the cases, area sharing means there will be 200 flats, so 80 flats will be owned by the developer and 120 by the landowner. The interconnection will be, there will be execution of conveyance deed also. And once that is there, even though they are joint development partner, it will be taxed at the rate of 5% also if it is a residential project. So even though it is a JDA, it would attract GST. So this is the various kind of queries that normally we receive. Who is liable to pay GST on TDR, developer under RCM in both cases. Exemption up to BU is received. Who is liable to pay GST on construction services under, if there is a construction service, then it is forward charge. And earlier it is in RCM, because if it is GST on TDR. So then valuation of TDR equal to value of similar apartment nearest to date of TDR agreement. Valuation of construction service like equal to value of similar apartment nearest to date of TDR agreement, less 1/3 is for the deemed value of land. Now we have got couple of high court judgments that it is not mandatory that you can take 1/3 only for the deemed value of land. If the actual value of land is more than 1/3, you can take it. It is not a reservation, rock solid reservation or the restriction. That is also the view of various high courts. However, we will have to see how department takes it. GST rate on TDR is 18%, construction service that we have already seen 1% or 12%. And this is manner of calculation of tax on TDR, valuation of unbooked units, and eligibility of ITC. ITC not allowed in case of residential project for the developer, and for commercial project, the ITC is allowed. This is a revenue sharing JDA. Percentage of project revenue will have to be shared between two. However, there is also GST impact on this revenue sharing JDA also. This is the most of the questions are saying. Case study on TDR. Ahmedabad Municipal Corporation issues work order to a contractor ABC Limited for redevelopment of slum. In consideration for redevelopment of slum area, AMC will grant TDRs to ABC Limited. Such TDRs are freely transferable, and hence ABC Limited transfers such TDRs to DAER, who in turn uses such TDRs to get plan pass for its own independent residential commercial construction project. So what will be the GST implication? So the recipient is DEF. So whatever amount that he has paid, DEF has paid to the ABC. On that amount, if there is a commercial project, then 18% GST will have to be paid. And if there is a residential, then after BU, the developer will have to discharge on the portion of the non-sold or unsold units of the residential project. ITC reversal, very important. It was earlier till 31st March 2019. Reversal had to be made on particular financial year. However, after 1/4/2019, turnover basis to area base. Suppose for this example, if we give there is a project which lasts for 3 years, and on 3rd year the completion certification is received, and after that completion certificate is received in that financial year, whatever amount of ITC is there only needs to be reversed. However, after 1/4/2019, entire project or entire area has to be covered, and based on that turnover basis, whatever amount is unsold, suppose I have 100 commercial units and 30 units are not sold. So out of total ITC, I have to reverse 30% because I have discharged my liability only on 70% of my total area, and hence 30% ITC is not eligible because it has not taken the burden of GST. So if we see this example, project started 1/10/17, completion is 1/12/2019, total carpet area is 40,000, unsold is 12. And 17/18, total ITC available 3.5 crore, 4.5 crore, and 2 crore. Total is 10 crore. Taxable supplies is 50 crore. Exempt supply, that means after BU, whatever the inventory is sold is 15, total supplies is 65, and carpet area is 40,000. If we see prior 1/4/2019, if we see turnover basis, ITC reversal was only 1.2 crore. But post 1/4/2019, if we see carpet area basis, the ITC reversal is 3 crore. So after 1/4/2019, it is more logical. However, the amount of ITC reversal has increased in case of carpet area basis after 1/4/2019. So it is a right and logical step or the correction by the government. However, the ITC benefit is restricted in this case. Various models of joint development, area sharing, revenue sharing, joint venture projects, redevelopment, slum rehabilitation, joint development of plotting of land. This is their GST applicability in case of redevelopment. In our view, redevelopment of society would not attract GST. Society to developer not taxable, developer to society all members taxable in the case that value of similar apartment sold nearest to the date of issuance, less value of land, so works contract component has to be, and developer to new members, naturally transaction value will be taxed at 5%. GST on plotting of land, we have already discussed. Vacant land, not taxable, vacant land with basic amenities as per Gujarat High Court judgment, not taxable, but vacant land plotting along with luxurious amenities needs to be checked, needs to be planned out in a right way to avoid any litigation. This is an AR that we have already discussed. This is our recent Gujarat High Court Munjal Manish Bhai Bhatt versus Union of India decision. And works contract service, definition under service tax of any movable or immovable property, and under GST regime of any immovable property, the definition has been restricted. Real estate sector, works contract service, GST analysis, this we have already seen in my earlier. I think these posers we can skip it because I think it is already 4:52. So maybe I think these posers like USM and all that. This value maintenance deposit is not taxable in this case. However, advance maintenance charges, please keep in mind, advance maintenance charges is taxable at the rate of 18%. And I think that's it from my side. We can take up any questions if any of the members have on real estate sector and any kind of related issues on GST for real estate works contract or government contractors.
Sure, sir. Sir, thank you so much for this detailed deliberation. I will take up the questions. I will read out the questions for you, sir. So we have quite a few questions, sir. I will start with the first one. What will be the GST taxability if there is a sale of plot of land after just marking of plotting by area basis?
So GST plotting of land is if there is 100-acre land and I make 1 acre 100 plots, 1 acre each, right? So if that what the judgment says, if it is having drainage, electricity and basic compound wall, and for that I charge them maybe say 2 crore rupees for 1 acre plot, those 2 crore would attract stamp duty also. And there are no further development like I said, swimming pool and courts, tennis court and this and that. It is only involving those 2-3 basic amenities. For that, I have charged them 2 crore on which stamp duty is discharged. Then there is no GST on that. So only basic mark on that and basic amenities is there, then there is no tax. However, if there are luxurious amenities or more than that, in my personal view, even though it is there, it is all imbibed. People that do not come for swimming pool facility or that, it is an added advantage. And hence, it is only a sale of land in my personal opinion. And hence, even though there are further amenities, it should not be taxed. It is only sale of land. But since now it has gone into controversy because of AAR and AAAR, 18% should be charged on entire 2 crore. So in my opinion, there should be 2 companies. One is purchase and sale of land. Second is infrastructure development companies, which will do clubhouse and all that. And suppose third transaction happens, which I forgot to mention. Suppose I come out that, okay, I want 3-bedroom apartment, and based on 3 or 4 elevation that they have decided that, okay, I want 3 BHK construction to be done. Then in that case, that infrastructure development company will take a construction agreement from me. We will enter into that on 300 rupees stamp paper. And for that, whatever amount, suppose he charges me 70 lakhs for that, on 70 lakhs, there will be 18%, because then it becomes a works contract service. So these 3 lakhs are there. First is only basic amenities. Don't worry, no need to take even GST number unless there is some RCM liability. Second is, if there are luxurious amenities, make 2 companies. One is for land, one is for infrastructure development. And third is, if there are various kind of weekend homes need to be constructed, then on that 18% works contract service to be charged.
That's it. Sir, second question is, I purchased a flat from site owner out of his share of area given to him by the developer of land and a development agreement. Now the site owner is of the view that there is no GST on flat being sold to me by him out of his share. Is that stand of site owner correct, sir?
I missed your first sentence. It didn't.
Sure, I will repeat. I purchased a flat from the site owner out of his share of area given to him by the developer. And now the site owner is of the view that there is no GST on the flat being sold to me by him. So it is talking about the site owner who is taking a flat from a developer, sir. So whether his share would be taxable.
Yeah, so let us take an example that yes, I and you both are partner, and we constructed jointly, and you got 35 flats, I got 25 flats, so 60 flats is there. Now out of my 25 flats, I am going to sell 1 flat to say Pragya, right? So those 25 flats which comes into my kitty, first of all, it needs to be executed in my favor as per stamp duty, and because I and Amish and Yes associates is the owner of that entire project, not individual. So that is a capital that you have brought, capital in form of land. I have brought maybe construction by way of 20-25 crore into that, but that does not give any different sanctity in law. So even though you get 35 flats, I get 25 flats, it has to be executed. If our partnership firm is there, then partnership firm, that is a developer firm, will give you 35 flats. After paying stamp duty, I will get 25 flats after stamp duty and 5% GST. So that is also applicable. Now out of those 25 flats, if I further sell to Pragya, it is a second sale, it will attract only stamp duty, it will not attract GST. But if it is a first allotment, then it must attract 5% GST. If it is a flat and more than 45 lakhs that we presume, then it would attract, even though it is my part. So suppose I tell that, okay, yes, this is my part of 25 flats and your part of 35. And then I give it without any execution from the developer company to me. I just directly directed someone that, okay, you give it to Pragya directly, then it is a first sale and it would attract stamp duty as well as 5% GST. So in my opinion, site owner's claim, if it is a first allotment, is not true. At least it would attract GST first time. So 5% will be there.
Okay. Next is whether leasehold land allotted by government for installing industry, if due to any reason is being transferred to any other party who installed industry and running for which registrar of property has charged stamp duty on it, whether this transaction of transfer is liable to GST if lease is for 19 years.
Yeah. So this is, let us take one more example. Suppose there is a Gujarat Industrial Development Corporation, GIDC, MIDC, Rajasthan, RIDC, and all that. suppose I have taken on 99 years lease, because as per Constitution of India, there are certain land which cannot be taken, like Greater Noida, then Sabarmati riverfront in Ahmedabad, then Gift City, all those land are for 99 years lease. So it's the same way I have got a plot of 2000 square yard from GIDC, but by paying maybe 6% stamp duty, which is there in Gujarat. And I purchased it or leased it out. Actually, it is as good as purchased, because after 99 years, it can be renewed for ₹1 for another 99 years. So it is a long lease, more than 30 years. As per GIDC and as per GST Act, it is not taxable, because by an industrial corporation to an industrial unit, more than 30 years is exempt. So I ran that industry of or that factory of 2000 square yard for 25 years, and now I want to retire. So you came to me that, Mr. Ramesh, I want to purchase this factory along with land, and you are ready to pay me 5 crore for that particular land plus building. So now on that 5 crore, 6% stamp duty will also have to be discharged, as well as we will have to, you will have to approach to GIDC for NOC and transfer. So after some payment, they will issue NOC and will transfer it into your name. Now this comes that as a first LOT from GIDC, I was exempt, because it was an allotment by an industrial unit, by an industrial corporation to an industrial unit, that is me. Now I am not an industrial authority. So is the second sale is taxable, and we have already from Gujarat Chamber, we have already represented to GST Council, because thousands of SOCOS notices are issued or based on the second sale. Suppose I now what happened that I sold it for 5 crore to you. You paid me 5 crore. However, I will receive a SOCOS notice from GST department for 90 lakhs. That, okay, you have transferred it. It is a lease agreement. It is a lease, and whatever you are getting is attracting 18% GST. So in that case, number of thousands of SOCOSs are issued, and all commissionerates will issue that. This will reach at least again up to Supreme Court, or government may give some clarification to it. And the irony is that, suppose you and I are aware of that, and you pay me 5 crore 90 lakhs, I pay 90 lakhs to GST department. Whether Mr. Yash will be eligible for 90 lakhs ITC is also a controversy, because there are two schools of thoughts. One is that it is related to immovable property, and that 90 lakhs cannot be taken as ITC. So there is it is a really miserable position. First, that I would receive 90 lakhs SOCOS notice after 2, 3, 4 years. Every year 18% interest component is there. And suppose even though you have paid me 5.90 crore, you may not receive 90 lakhs. If you have utilized, you may also receive that SOCOS notice for 90 lakhs. But very true, it is really a painful point, but as a consultant, we must advise second sale as per current law is not exempt, and hence one should charge 18%.
Okay, sir. Next one is with respect to TDR, sir. What about GST on TDR, where completion certificate is received in June 23? However, the development agreement was entered before 1/4/19.
Okay. If the development agreement is entered before 1/4/19 and the consideration has also flown before 1/4/19, suppose we presume that, and now तो क्या रहेगा कि उसमें वो टाइम पे between 1/7/17 to 31st March 19 there was no provision of reverse charge. Hence, suppose this TDR is of 10 crore and which has been entered, suppose on 1/1/19, that is before 31st March 2019, these all changes will come. On 1/1/19, this agreement was done and 10 crore has already been paid. Then it would have been, or rather it is taxable under forward charge mechanism, not reverse charge. Because after 1/4/19, it is under reverse charge. And mind you, before 1/4/19, it was 18% under forward charge for both residence and commercial. Because at that time, residence was not 5%. It was 12% with ITC.
Yes.
the person who has received 10 crore, he would receive a so-cause notice from department that why he has not discharged, he has not collected and discharged under forward charge mechanism 18%. So suppose it is 10 crore amount that he has received on 1/1/19, then 1.80 crore so-cause notice he would receive. Even though the project is now completed in April 2023, will not change any materiality aspect. However, it can so happen, in my 20 years experience in indirect tax, that both will receive so-cause notice. The person who has received 10 crore will receive that why you have not discharged under FCM, and the person who has received now BU will also receive that why you are not discharging under RCM. But be as it may, I think RCM person will not have to worry much, but the person who has received 10 crore, he had to discharge under forward charge. But nothing has been done. Better you take so-cause notice and litigate out. There are all chances that wisdom will prevail, and land includes its accrual also, and the TDR is also part of land. If that is the decision by a High Court or Supreme Court, then it is a problem. Then it is a very good situation. Otherwise, it is a problem for the person who has received amount.
Taking the same stand in last transaction where second sale happens, sir, can we take a way out in that manner, benefits arising out of land, and thus it's a state matter out of this central GST? Is that a position which could be taken in future times, sir?
Yeah. In GIDC also we are taking one more stand that this land is just a minute. Sorry, that builder association has also taken a stand in long-term lease in case before Supreme Court that this long-term lease is not taxable, is taxable. Sorry, but in my opinion, that second sale by GIDC is very difficult unless there is, which we have suggested to council also, there is a change in law that any allotment by an industrial corporation to an industrial unit, and any allotment and any subsequent allotment, after allotment, any subsequent original allotment and subsequent allotment. If that word is subsequent is not added in law, till then I do not see more chances that this are, but it is surely a good argument to plead before courts. But
taking it to Schedule 3, taking it to Schedule 3, sale of land and getting out of that, not going into the exemption parts.
Yeah. So, but yeah, subsequent, because this you purchase from me and now you also sell as a yes. Second person. So it is going to be, it is going to have multiplier effect, and more so when you are not getting even ITC. And so we have advised our clients that you take ITC, avail ITC, don't utilize it, keep it in your part. Protest. And and in future, suppose you or someone else wins their case in court of law, at least you will be able to, whatever you have availed, since you don't utilize it, you don't incur interest portion, but if luckily you win, then you can utilize it in person. Yes, so yes. Kind of practical view we will have to take as a consultant.
Yes. Sir, we have last two questions. With your permission, should we take it?
Yes.
Sure. Sir, next question is, can GST from a flat owner be recovered?
Can GST from a
flat owner be recovered? Yeah. Basically, I think so. He is trying to say whether GST from this land and land portion and the owner portion for this redevelopment agreements where flat owner share get accumulated.
Yeah, what is happening in redevelopment is, suppose there are 10 flats, old flats, and now suppose another 6 flats are getting constructed. So total 16 flats are there. New 6 flats, as we discussed, would attract 5% GST. That's okay. And all the 10 flats owners, what they are relinquishing is they are relinquishing their right in share of land, right? So those share of land is being allotted to the new 6 owners, right? And that against relinquishment of proportionate share in land, they are getting the new construction, right? So some department can take a view that this new construction, which these all 10 members are getting, is a works contract services. Those 10 members are already owner of the land. Only they are getting is the new construction against relinquishment of land, and a litigation can happen that what is suppose value of land or the value of construction is the service that is been flown from one to another. However, what we have done is we have taken a practical view that whatever is the construction cost of the new 6 flats, so every flat, and that we apportion it to the old 10 flat owners, kitty, that okay, this much the amount, and on that 18% the redeveloper should have charged it, and for that portion is, since 18% is being charged under works contract service, he is proportionately allowed ITC also, and there will be only 10, 15, 20% only which needs to be paid in cash by developer. A rest will be taken care of ITC. So suppose this matter goes into tribunal or further court, at least I can plead that I would discharge on the works contract part of the all 10 flats, right? And since I was eligible, I utilized my ITC. I paid also 20%, 15%, depending on case to case in GST. And hence I am a law-abiding citizen, and unnecessary 18%, because otherwise also those 18% ITC is going to be vested. So we utilized it and paid difference in cash, and that way we have covered. So it is a for 10 old flats, it is a works contract service. For new 6 flats, developer service, residential or complex service along with land and building. And that's a practical view that we have advised to our clients.
Yes, sir. Last question I will take up, sir. In case of redevelopment of building, if the owner enters into development rights with the builder, rate of GST and what is the rate of GST and who has to pay?
See, in our last example only, suppose we have 10 flats which gets into redevelopment and new 16 flats are entered. Now I relinquish my share of land, or maybe 10 put together, society enters into the agreement with the redevelopment or the builder, right? So against those, what society is getting, it is getting nothing, but it is getting new construction. So there is one school of thought that whatever society is entering into an agreement, and whatever the value of service that society gets, so the value of new construction gets, should be taxed. That is a one school of thought. With due respect, I don't agree with that, because if we go on that way, then I think we can never reach to a situation where it is a kind of business possibility. Feasibility will not be there of any project. So if whatever society gets, I think society gets nothing. That notional value should not be considered, that the value of construction. Rather, those construction has been done by the developer, and that is, we should tell the developer that he should pay on the construction value of the all 10 flats by utilizing ITC and remaining portion by cash. And we have never advised any of our clients that society or the individual owner of the 10 flats, each owner should take any registration, because they are getting new construction in lieu of relinquishment of land, and we have not taken a position that it is taxable. So whatever taxability is there, the developer or the builder would discharge it under works contract services for 10 units, 10 old units, and on the new 6 units, as usual, will get taxed at 5%.
In same redevelopment, sir, there is a continuation of question. If land and building is conveyed to the builder for redevelopment of residential building, whether GST is applicable? If yes, who has to pay?
Plant and building?
No, if land and building is conveyed to the builder for redevelopment of residential building,
okay,
whether GST is applicable? If yes, who has to pay, sir?
See, land and building is conveyed. There are two kinds of things. One is, it is never a sale of land. it is only a development right. And those development right only to the extent of, you can see the new 6 flats, right? That is handed over to the builder. Suppose we take that there is 10 members and there is 1000 square yard plot. And so every member gets undivided share of land of 100 square yard. Now, instead of 10, suppose you say that about 16 flats are getting constructed. So if we see, so every person will get 60 yards. So 10 into 40, 10 members into 40 square yard, 400 square yard land is being given to the developer. So against 400 square yard of land, the old 10 members or the society gets new construction. So it is conveyed means if it is sale of land, it's a different strategy or different transaction altogether. If it is an only relinquishment of right or relinquishment of land to this extent, then again my earlier reply will apply that, okay, against 400 square yard of land, I am getting new construction and that will be taxed in the hands of developer only. There is one school of thought also that whatever amount of construction is being done for the old 10 members is going to be recovered from the new 6 members. So if you see in totality, the entire, the value, project value is getting taxed, right? So suppose, are you getting my point? Or yeah, because the old 10 members, whatever
Yes.
we are providing them construction service, that cost we are recovering from the new 6 members, and new 6 members are getting taxed at 5%. So if we see ideally, then only 6 new members only should be taxed. But this ideal situation does not arise in practical life, and hence to safeguard our position, not 100%, but near to 100%, we have told our developer clients that you are providing works contract service to old 10 members who are giving you land, and against land you are giving them new construction service because they are already landowners for their particular flat, and those works contract service is taxable. So उसके ऊपर आप 18% notional tax value गिन के, notional construction value गिन के आप उनके ऊपर discharge करो, and ITC you can avail, and remaining if there is anything you can pay in cash. So all answers, both answers almost is in hand in hand, except if the entire building is sold, right, and the old members go away, or old members get a new allotment, then it is a like 6 old new members are entering into the situation. That is the only change. Otherwise, I can see both answers would be same.
Thank you so much, Amish sir. It was a wonderful session, quite detailed and quite practical examples, and everything was typical. Heartfelt gratitude to you, sir. Thank you so much for deliberating on this very complex issue of real estate. Every now and then we have lots of questions, queries around this subject topic. Thank you so much, sir, for coming and enlightening us on this very complex topic, sir.
Yeah, thank you so much. Thank you.
Yeah, thank you to all the participants for staying back till here. Hope you had a great session. Have a great day ahead. Thank you.